All right. Excuse me. Wow. All right. Good morning. It is Friday. It is the 12th of January. It is 6:32 a.m. We just had the PPI come out. So we're going to jump straight into the content here. I'm just going to throw up on the right-hand top corner our QR code. If you want to zap that, take you to our website, let you know who we are, what we do, etc., etc. I'm going to go ahead and share the screen. We're going to take a look at the PPI data that just came out, and we're going to discuss what that might be doing to markets as we speak. Okay, so let me just go ahead and grab a little bit of information while everybody hopefully can take a look at the bottom of the screen here. You can see these numbers, the PPI itself, which is the producer price index. Now, that is effectively the measure of inflation on the producer side, on the production side. Okay, so what does that mean? Look, here's the deal. An economy is made of production and consumption. You're going to have people producing, people who say like they run factories or they are maybe a small operation, right? And they just, they might make widgets. They might be like a CNC company where they're just making small things, right? Or they could be a very large factory, and whatever it is they're producing. And producers have their own measure of inflation, right? They have inputs to their products, they have energy, they have rent, they have all kinds of things that will affect the amount of money they have to spend before a product gets made. And when that happens, they end up transferring a lot of that price, of course, to the end consumer who buys it at the store. Because if it costs you more to produce, then it's going to cost the customer more to buy that because you have to cover your cost as a producer. So PPI is a leading indicator to inflation. Now, historically, I've been watching this because yesterday was CPI, which is, of course, the main headline inflation. What everybody's looking at is the consumer price inflation. But the PPI, to me, now it's interesting that this should be less after the CPI is more. It would make sense from a standpoint of it being a leading indicator, because now you're looking at a scenario where, okay, maybe next month this will follow, right? I know historically one has kind of followed the other, but not always. And this is one of the not always scenarios. So this might be a preview to next month's CPI. And the way this works in the charts, let me pull up the proper screen here. Let's look at, say, the EUR versus the USD. And don't let this screen freak you out. Let me just clean it up so you don't have so many gobbledygook things to look at, the crazy patterns and whatnot on the screen. This is the euro versus the dollar. This is the euro in terms of the dollar. This is a Forex market readout, okay? So Forex is a measure of one currency versus another. In this case, like I said, it's the euro versus the dollar. And on a lower time frame, we can see the effect of this. If you think about this, if the PPI, right, the inflation for producers is actually going down, the thought is that the Fed, Chairman Powell hiking rates, the thought is that the rate hike has helped, because the idea is the rate hikes were causing the economy to contract a bit. Money got more expensive. It's harder to actually fund, it's harder to fund operations. It's harder to fund investments while money gets more expensive. And the whole idea there was to cause businesses to have a little bit harder of a time and to cause things to contract. And when things contract, things tend to get less expensive. So that's the idea. Now, if you have a PPI that's showing a lack of inflation on the production side, the thought is going to be that lack of inflation is transferred to those who are actually consuming the products, right? So, okay, you go to the store, things are going to be cheaper. That's the idea. And that is an indication that the rate hikes have done their job. Okay. So if that's the case, then the popular thought is that, okay, the rate hikes have done their job, and the next Fed meeting might be either not a rate hike, and the next few Fed meetings might even see a rate cut. Because if the rate hikes have done their job, then they may have to go ahead and cut the rates to make up for it, and inflation might have already been passed us by. That's the way this goes. Now, what does that mean on the charts? And this applies to everything that trades against the dollar, not just currencies. It's going to apply to like cryptocurrency. It's going to apply to stocks. We can look at the effect on some of the indices. It might have a temporary effect, or it might turn everything around. I'm going to guess it's a temporary effect because yesterday the CPI was actually pretty hot. And the CPI yesterday was hotter in comparison to today's PPI. So how this data gets read is going to be in question. But for now, we have the EUR USD. Okay. And because the USD is perceivably becoming weaker, right? Meaning that prices have gone down. The thought is we might see a rate cut in the future. That is an indication that the dollar might be getting weaker just by function of cuts in the future. Then the market's going to treat that as if it's happening now or soon. And then that means the dollar is going down. All right. Then it's going to push the euro up, which is what we just saw right here in this 5-minute candle, right? So 630 is this large, let me zoom this in, this large blue candle right there, that bullish candle, that's the announcement causing a push up in the dollar. Now, the trick is trading these events, right? These economic data releases is not as easy as it seems. There's a lot of, there are a lot of manipulations that happen during this time. In fact, some believe, and I am some, that the market manipulation occurs when these data announcements come out. And that is because they can, right? You can't just go manipulating the price if you're like a large asset manager, or you're a sovereign wealth fund, or any of those things. You can't just go manipulating prices. I mean, you have the ability to, but you'll get in trouble legally. But when these announcements come out, they kind of have carte blanche to move price where they want, at least in the short term. And it's very dangerous to trade during that time because people at that level, they know where all of your stop losses are. They know where your liquidations are. They have all the data. They have the Bloomberg terminals that can tell them everything. So I personally don't trade during these events. I have kind of made some attempts at doing it, and it's kind of hit or miss. I used to do some time ago, I would do what's called a bracket trade, where I would put a long on top of price and a short below the price, and price would go through one. If you're super nimble, you might be able to pull some money out of it. But personally, I think there are just too many good opportunities to take without doing that kind of thing. That's just the way I roll. So, but this is the PPI. This is the data that came out. Let's take a look at what next week looks like so we can understand what our trading week is going to look like. Today is the 12th. So Monday, I don't see, actually Monday's going to be quiet. It's in the United States, it's Martin Luther King Jr. Day. So it's going to be a holiday. Monday's going to be a day off. I might take a day off. I don't know. I might take a day off from doing live shows. That's very likely. I might go ahead and do everything else I always do. I have so much to do. Tuesday, the 16th, in the London Open, there's going to be the some unemployment data coming out. So if you are trading the cable or anything that's related to the British pound, you might see some action there, right? Kind of similar to the PPI that we saw today. On Tuesday, the loonie, the Canadian dollar, at 6:30 a.m., their CPI data comes out. So if you're trading the loonie, understand there will be volatility there. And at the same time, the Empire State Manufacturing Index comes out, and that is at 8:30 a.m. EST on Monday. Okay, so there will be some volatility, at least in the dollar, and definitely volatility for the Canadian dollar. And if you're trading the USD CAD, look out. All right, so then we have some data coming out for the Chinese yuan. That's the industrial production year-over-year data, and that is at 9 p.m. EST. So you're talking about a few hours before the London Open, a little bit after the Asian Open. If you're trading, anything related to CNY, then you're gonna see that that's an issue. Of course, the next morning, Wednesday, the 17th, right at the London Open, you're going to see that's at 2 a.m. EST. So London time, I believe they open at 8, if I'm not mistaken, 8 a.m. UTC. You have their CPI coming out. So again, some pretty big action on the British pound, Wednesday, London Open. Now you've got also 6:30 a.m. for the US, this should spice up the market that day. You've got retail sales, which is an indicator of overall strength. So, just to kind of remind everybody how this might work on Wednesday, the 17th of January at 8:30 a.m. EST, which is an hour before the New York Open. Okay, this might work in such a way that if retail sales comes out kind of lower month over month, with it really should, simply because by nature of it being January, more people bought things during Christmas the month before, leading up to Christmas. I would imagine that the retail sales is going to be a red number, an indication of the economy being weaker, an indication that we might have to see either no hike or cuts in the future. And then, of course, I think the dollar might get weaker. Anything traded against the dollar might get stronger, right? So you might see stocks and everything else kind of take a little bump that day. Whether or not it's temporary is going to be another scenario, but I do think that there might be some money to be made on a little bit of bullishness that day. If my prediction is correct, and it may not be, and whatever I say is not investment advice. Okay, so make sure you're doing your own research before you make any decisions in trading, because you can lose your money. Trading is risky inherently. Wednesday at 7:30 p.m. EST, you have the Aussie Australia employment change and unemployment rate. Similar effect, of course. If this is a red number, then their stocks and everything else in the Australian realm will probably take a bump up, whether it is temporary or whether it is uh, sustained will have to do with which direction the market is already going, in my opinion. We have unemployment claims, which is every Thursday at 6:30 a.m. So that's always a piece of data that will come out. That's a week over week metric. So it will have an effect. You see that red kind of file folder, if you will. That is an indication, um, you know, that it will have an effect. I mean, the file folder is in the right. I don't know what this icon is. It looks like some kind of weird square fire. Anyway, on Friday at the London Open, we have the retail sales for GBP. Okay. And we have at 10 a.m. EST, we have the University of, wow, I'm stuttering. Wow. The University of Michigan consumer sentiment data. And so basically, U of M has been reading consumer sentiment for a number of years. So the data is coming out of U of M. And that is the week. So on Friday, it'll be, is that, excuse me, that's going to be like 30 minutes after market open. And I think this is a month over month look. So you might see some significant effect on the markets. Okay. So let me see if I can pull a video up. I want to give credit where credit is due. There is a channel, and I'm going to pop it up here. It's called Crypto World. And on the video, I will be putting the link in the description to this guy. He does good TA, for just your basic price action TA, a couple basic indicators. From a TA standpoint, the Crypto World channel, you can see that. Let me zoom it in, and I will put this link right now in the description over on YouTube. So give me just a moment to do that. Now, what he's saying, so we did a trade in the private room yesterday, right? And we got knocked out of that trade because the charts were saying that the price would go up, right? So, and they did not. So let me add this link to Crypto World. So that is now in the description for everybody. The point here, though, is that the charts said everything should go up. The liquidity nodes were lower and higher, but the charts favored a move up. I took a long. I got knocked out of that long. It was an ugly, ugly move down. We're going to actually show that move down, by the way, shortly. Okay, so we're going to do that, but let me just explain what happened. In fact, it's on the screen right now. Let's see if I can just zoom this out. This is on a 3-minute chart. This happened yesterday, right after the ETF, or 2 days ago after the ETF approval. And so price, actually, it was yesterday morning after the ETA approval, the day before. And so basically, price was moving pretty strong to the upside. And then I got knocked out of a trade. So I took the trade during the live lab saying, okay, if the price comes to this area of interest, I'm going to take a long. And price went all the way back down, just all the way back down to below my stop loss, which was unexpected. Well, it turns out what happened, according to this gentleman here over at Crypto World, is that there's that's called the GBTC arbitrage. Okay, so Grayscale Bitcoin was and is now converted over to an ETF. Before Grayscale Bitcoin was a trust, is what that was called. And so let me run over to the Bitcoin chart. You can see that the move up is already being pushed back down on the euro. So that move appears to have been temporary. Okay, we're going to take a look at the Bitcoin chart. And we're going to look at a higher time frame. So give us a moment here, us being me. And I want to show you how I got knocked out of this trade. I was like, this is like some kind of manipulation. This isn't right. Well, actually, it wasn't a purposeful manipulation necessarily, but I had a trade on, and the logic was that there was a bit of a consolidation and a range was developed and built more or less like this. I mean, it's kind of a dirty range, but it was there. And so as price moved up, my area of interest was kind of above some of this price. And then there was liquidity up around 51,000. So I had a trade that looked at the time kind of like this. Let's say, I think I entered above here or above here. I think it was like here. It was a little higher than I wanted, but there was so much risk to reward I didn't mind. And my targets were up here in this range, a little higher. It was below 53. So this is what the trade kind of looked like. For instructional purposes, this is good enough. And you can see that immediately the price tanked downwards. Just like it moved up very powerfully and then it got knocked down. And what happened was Grayscale Bitcoin Trust. It's a massive trust. They owned a bunch of Bitcoin and you could buy them on like the US stock exchange and so on and so forth. And people, it would always trade at either a premium or a discount, depending where the market was, right? And at the time of the ETF approval, the Grayscale Bitcoin Trust at the time, GBTC, was trading at a discount, meaning that you could buy exposure to Bitcoin for cheaper than Bitcoin. Well, in this case, once it got converted, or at least was undergoing the conversion to ETF, that discount meant that people were able to buy Bitcoin at a cheaper price than Bitcoin. And because it was such a massive trust, that enabled people to go ahead and sell their actual Bitcoin holdings, move the money over to Grayscale. And this is probably, I'm guessing this was happening at an institutional level for it to have this effect. I don't know that your average Joe really understands this arbitrage opportunity in order to, enough to push price in this direction. But I'm sure this was a big plan. They waited for the bulls to kick in, and then they would sell the real Bitcoin to buy what is now effectively real Bitcoin over at GBTC, but was trading at a discount, right? So let's visualize how that works. You got your Bitcoin price here. We're going to zoom into this, so give us a moment. And we'll erase this, and we'll kind of move these to center screen. We'll make this a little easier to see. So this market reaction was unexpected, at least from my standpoint. With Bitcoin, almost nothing is unexpectable, but it just didn't fit what the price action said, right? I don't generally take Bitcoin trades unless I'm pretty confident in them, because Bitcoin is pretty wild. But the point here is that, so the arbitrage for this, like Grayscale is over here, right? So this is the Grayscale Bitcoin price. Right here. And then here is going to be just like spot Bitcoin. Whoa. Spot Bitcoin is just Bitcoin. It's actual Bitcoin that you can buy. Okay. Now the price of Bitcoin was higher, so people could sell that price, right? And then they could take some profit off the top, and it would look like, say, like that. They could sell that, take this amount, and buy some Grayscale Bitcoin with it, right? And so that, would effectively push Grayscale Bitcoin price up. And this bit of profit is something that take advantage of, and it would push the price of spot down just a hair, right? And then they would sell more spot, which would push it down just a hair, buy more grayscale, which would push it up just a hair, sell more spot, down a hair, buy more grayscale, up a hair, right? So you can see that eventually the prices even out. That's how arbitrage works, okay? So arbitrage is not a new thing. In fact, I actually started making my first crypto money on what's called spread arbitrage. So I'm very familiar with the concept. And eventually these are, approaching an even out scenario. But it was, Grayscale was such a large player that arbitrage was able to crush BTC downwards. So this is what happened. This is what happened to the price of Bitcoin. Why in such a bullish time it would go down. And there's always that chance that your large players understood this was happening. So hold on a second. I got to bring the gorilla in. Gorilla.
Yeah. I was in the back, man, listening to this whole thing for like 30 minutes.
30 minutes, my ass.
Whatever, man. Make it like 20 some odd minutes.
Is it that? Was it really that, bro?
Yeah.
Text me or call me, man.
Dude, I texted you in the private chat. I'm like, this guy's not getting it. I waited a little while. Let me text him in Telegram. So at 8:46, I texted you. I've been here for like 20 minutes, bro.
Just listening. 8:46 is like 7 minutes ago, bro.
Whatever. 7 minutes is an eternity when you're backstage.
Kind of is. It kind of is. So we were talking about the.
I'm reading. You're sitting here talking. I'm just like sitting here listening to you. I'm looking up like at I'm like, what do I do?
Well, you know how it is, man. You're on a roll. You're trying to explain something.
No, it's all good.
Just you get that tunnel vision. You know what I mean?
Yeah. Listen, guys, you're listening to Cowboy Break It Down. Flash that, scan that QR code. Join us. AlgoFactory.tech. This is it, 2024. Let's make it happen. Looks like World War III is starting.
Yeah, dude, that's going to affect things. We're gonna have to talk about that, especially. I think. Look, we had some amazing drips yesterday in the private live lab. So, and I think we pretty much have finished the grayscale. The reason we had that big move down. That was that was an arbitrage. Link is in the description for the gentleman who wrote that original video. Really good work. So check that out. And that's over at Crypto World. So again, yeah, the effects of what's going on in Yemen, right? Is it Yemen?
Mm-hmm.
Yeah, so the U.S. is dropping bombs on Yemen at the direction of the president or whoever tells him what to do. So, that being the case, we do have to be concerned about how that might affect markets. I think oil is probably the one to look at. What do you think?
Oil is a big thing to look at.
Well, let's take a quick look.
Let's look at the oil. Let's look at the Baltic Dry Index. There's so many things to look at here that is going to be affecting world trade in a major way.
You're a G, bro. You brought out the Baltic Dry Index. That's
man, they don't call me the gorilla for nothing, bro.
Yeah, that's G unit right there. That's like, dude, that's the real deal. If you know about the Baltic Dry Index, you, sir, are probably some kind of trader.
Maybe.
Oil at the moment is actually kind of chill for everything that's going on.
It is chill because speculators are expecting that the U.S. and the West will have that situation in the Red Sea taken care of. So that
I'm not sure it's going to go like that, dude.
I don't go like that at all.
Yeah, I'm not so confident because does the U.S. really have the manpower for such a conflict?
No, and here's the thing: the Saudis were fighting the Houthis for years at this point, right? And they
using U.S. provided weapons.
Yep, U.S. provided weapons. I mean, and it wasn't like old U.S. equipment. No, they were buying state of the art, the latest, greatest M1A2s with the Chabam armor. A lot of guys like, they were getting the export version. No, they were getting the full fat. In fact, they were getting the F-15s, the Eurofighters. They were buying. They weren't just given like old ass equipment or near to well equipment like in the Ukraine. They were given top notch stuff. And what happened? The Saudis couldn't do it, even with U.S. quote unquote contractors helping them. They could not do what they needed to do. And that was a wake up call to the Saudis as well as the UAE, who was also helping to finance it and providing air support during that as well. And they realized these U.S. weapon systems suck. in actual real combat against a thinking enemy. And that's exactly what's happened. The Houthis started this thing knowing what was going to happen. They knew, hey, you know what? We're going to do this in the Red Sea. We expect the West to get involved. We expect airstrikes in Sana'a. We expect airstrikes in other cities in Yemen. We expect the U.S. to come on. What are they doing? They're waiting it out. Okay. They also got tunnels. They also got underground bunkers. They're going to wait it out. And here's the other thing. They also got some fantastic anti-ship missiles. So when those ships are in range, they're going to launch. And they're also got some pretty good, surface-to-air missiles. All right. And that's when those aircraft coming in low, they're going to get them. And
You think they
most
got
of
some?
all,
You think they got some silkworms?
they've had silkworms for a while. They've had silkworms for a while. And here's the thing. The other thing as well is that you have they're also waiting for ground troops to come on in. That's the whole thing. The very trap the West shouldn't go into at this time, a depleted West. We've had much of our munitions depleted in Ukraine.
In Ukraine, yeah, we don't have anything left unless we have some deep storage munitions.
Right. And people don't realize if we were to fight a full-on conventional war in Russia before Ukraine with all of our weapon stores, we'd last about 2.5 weeks before we're out of everything. Fighting an enemy the caliber of Russia, right?
So caliber being the key word, by the way.
The key, exactly. So we fought Russia via proxy, and the Russians beat the U.S., beat the U.K., beat the French, beat the Germans, beat everybody in the entire NATO, or the entire NATO sphere with one hand tied behind their back. And we depleted our munitions. Now, if we, with our depleted munitions, now we're going in, UK has practically nothing, right? So with our depleted munitions, we're starting airstrikes in Yemen. We're hitting Sana'a, the capital of Yemen, right? We're hitting, it's dude, the worst trap in the worst time, in the worst predicament that we can be in, we're doing it right now. All the same time, we're encouraging Israel and the Netanyahu crowd to go along with this. Meanwhile, there is a mutiny afoot within the IDF that do not want to go along with this as well. So this is all going to play out very well. The U.S. military is not really interested in engaging in another war. A lot of politicians don't have the taste for this right now because their contingency is upset. The timing is incredible, Cowboy. It is unreal.
Well, here's an oil trade. So if oil is about to go up, like it should, by the way, and we'll look at the Baltic Dry. We don't have a lot of time. We'll do Baltic Dry in the private group. But for those of you who are kind of new to trading, the Baltic Dry Index has to do with shipping and shipped goods and the price of those, and it is a leading indicator that economists look at for whether or not we're going to see some trouble in the markets. So we'll get into that in the private group. And if you want to become part of that private group, it's extremely inexpensive right now. It's $49.99 a month. It's worth 5 or 6 times that. You can zap that QR code on the top right-hand side of the screen. Also, if you're watching this on YouTube, please like, subscribe, do all that YouTube-y type stuff for us. Okay.
Leave a comment.
Yeah, leave a comment. Actually, if you're watching this after the fact, if you leave a comment, that helps us out. But in the meantime, we have this trade right here. It's not that late to get into this. Ideally, the entry would have been down at 77.32 for Brent crude oil, but I would actually, realistically, you can enter this around 79.50. Now, I'm not saying you do this. I'm just talking about I'm doing this because we don't give investment advice. But if I were to take an oil trade, and I'm kind of interested in doing so, then I would be looking to go long right about here. And I would expect price after this double bottom to make its way up a little bit higher, especially as everything starts to unfold and the speculators understand that things may not go as well as they plan. Now, if I was in this trade, I might actually take some risk off at least before the price hits 100. And that's what this first target really is. This target at 93.65 is front running this kind of peak. This peaked out at 95.81. If you want to get a little more risky, I could say take my risk off or even some profit at 95 instead of 93, but I just like that 93.80 a little bit better than I like the 95. So this would be a trade that I would take. I'm going to look at a few things before I actually take that trade, but this I think is a good trade for me. And if you like this trade, then you need to do your own research and see if you can come up with a similar trade. And then if that's there for you, it's a freebie. freebie firmers. So what do you think, Gorilla? Should we go ahead and transfer over to the private?
Yeah, let's get it over.
All right. Give us that send off, brother.
Yeah, guys, listen, don't sit on the sidelines. There's a lot happening. You want the inside track on not only what's happening geopolitically, geostrategically, geoeconomically, as well as trading, as well as learning how to build the algorithms that trade on your behalf 24/7. This is the only place in the world that does it. Algo Factory.tech. He's the cowboy. I'm the gorilla. We're here every day making it happen. Cowboy, take it away. Join us or die.
Or die. Just kidding.
No, you don't have to die.
You don't have to die.